Hello, welcome to Traders Terminal. Based on your vote counts, we've decided to share one of our intraday trading strategies. This strategy is being personally used by us, and we've customized and used technical tools available at our disposal to make the best use of this strategy. So let's get started with the same. Opening range breakout. 15 minutes opening price movement is considered to be the trading range. When the price breaks out of the range, there is a big chance that the price action will continue in the same direction. This strategy should effectively be used in a trending market to avoid false signals. We personally use 3 minutes candlestick chart in volatile markets and 1 minute candlestick chart in less volatile markets. This conventional strategy is as relevant as it was a decade ago. We've added our own customizations and enhancements in order to increase its effectiveness and accuracy. False breakouts. Please note this is a very important point. False breakout has been the biggest challenge traders face while trading as per this strategy. In this video, we will tell you how to mitigate this risk using technical indicators. This video lesson is for educational purposes only. We advise all to do enough backtesting and paper trading to get a grip on this strategy. So let's get started with the same. Now, what is opening range and how do you determine the opening range? The first 5 candles in a 3-minute candlestick chart, we have used a 3-minute candlestick chart as you can see from the video. So the first 5 candles, first, second, third, fourth and fifth, this will eventually become our intraday trading range for a particular day. So we've taken the high of the first candle, which itself is the high of the trading range at 343, and we've taken the low of the third candle, which is at around 332. So this becomes an 11-point intraday trading range that we've come across. So now what this strategy says is that either side, whenever we get a breakout, we need to trade the trend. So for example, in this case, we are getting a breakout above 344 levels. So this strategy says that above 344 levels, you place a buy call. And below, if it would have given a breakout on the downside, we would have taken a short call below 332 levels. So what are the customizations that we've added in order to prevent false breakouts? Let's have a look. Number 1. Even in trending scripts, large percentage gap ups or gap downs should be avoided. Number 2. If large candle wicks are forming in the opening range, then that particular script should be avoided. Number 3. Volume confirmation on the side of the trend is essential to avoid false breakouts. Number 4. ADX above 25 levels coupled with RSI will help reduce false breakouts. This is very important point, I'll repeat. ADX above 25 levels coupled with RSI will help reduce false breakouts. And number 5. Bollinger Band squeeze in the trading range before the breakout will reduce chances of false breakouts. So let's see which all points fit in the example we've taken. Alright, so we've taken a 3-minute candlestick chart of Mahindra & Mahindra on 9th April 2020 to demonstrate this strategy. Now we know what is a trading range, what is a trading range breakout. What we need to determine is what can be an ideal entry point to benefit the most. And we have to decide the stop losses and target levels accordingly. Now let's have a look. First level of entry, as you can see, was decided at this particular point but was rejected as well. Why was it decided? Was because volume at this particular point indicated the buying momentum to continue, but rejection followed is because RSI at this particular point was trading above 75 levels, indicating overbought conditions. Here you can see from the cursor that RSI is trading at 76 levels. Now let's move on to another point which we could have picked as an entry point, this level. But this level also was rejected is because ADX was reading below 25. ADX is basically a strength indicator of a trend, and hence we require ADX reading about 25 in order to place a particular trade. At this particular point, ADX was reading below 25 and at 19 levels, and hence this level was rejected. This particular point could have been an ideal point. Let's have a look why. Number 1. Volume at this particular point is still, highest volume candle is still in green, and hence volume confirmation is still on the buy side. Number 2, ADX value is well above 25 levels and hence it qualifies from from ADX perspective as well. RSI. RSI at this particular level is at 50 levels, which is between overbought and oversold conditions, and hence we can initiate trade at this particular point. So what can be kept as the stop loss and target values? Let's have a look. Alright, so there could have been 3 potential stop loss levels and 3 potential target levels. We leave that to individual traders to decide as per their risk taking appetite and risk taking capacity. So what would have been these levels? Let me guide you. Number 1, top of trading range. This can be used as first trading stop loss. Number 2, trading range. This is the trading range which is of 11 points, and 11 points can be used as stop loss from the entry point. Number 3, base of trading range. The base of trading range can also be used as stop loss while trading, which is at 332 levels in this particular case. What could have been the potential target values? Number 1, trading range. Again, from the entry point of 350.5, trading range of 11 points, which would be around 360.5, could be kept as the first target. Number 2, 50% of trading range. 50% of trading range from 350.5 would be 5.5 points more, which is around 356 levels. 356 levels, and this can be used as target levels by safe traders to start booking profits. Number 3, percentage trailing stop loss for open target. This is basically trend riders or channel riders as we call them. What they do is they initially decide a stop loss level, and based on the stop loss level they determine what would be their target values. So let's take for example's sake that they've kept a stop loss at around 344 levels. So at 344 levels they've kept a stop loss when the script is trading at 350.5 levels, and at every percentage point move they'll trail stop loss further up towards the target value by a percentage. So what do I mean by that? If a script is trading at 350.5 and they have a stop loss at 344 levels, when it becomes to 353 or 354 levels, they'll trail stop loss by another percentage point up at around 347 or 348 points. This is how they'll continuously try to ride the trend and to keep trailing their stop losses and make the most of the particular trade. Alright, with this we conclude our intraday trading strategy lesson. I hope this information we've shared is helpful to all the traders out there. Please do like, share and subscribe to our YouTube channel. You can also visit and follow our Telegram channel. Link will be shared in the description below. We do share information and we also give intraday suggestions among other services. Go check it out, and yes, happy trading. Thank you.